and welcome back to the second episode of the Ameriwealth Talk Show. I'm your host Karan Murugesu. I am a CFP professional, a chartered financial consultant, and the founder of Ameriwealth Financial Group. Before we dive into today's episode, I just want to say thank you. The engagement and feedback for our first episode was truly heartwarming. I am grateful to each of you who tuned in, shared the show, and sent me your thoughts. So let's keep the momentum going. Here is a question for today. If you are a W-2 employee with just one household income, how much control do you really have over taxes and long-term planning? A lot of people assume not much. I don't have a business. I don't have any fancy deductions. What can I really do? But here's the truth. Even if your income comes from a W-2, there are smart IRS-approved strategies that you can follow to minimize your taxes. And two of my favorites are, number one, spousal IRAs, number two, health savings account, HSAs. They are powerful, practical, and available to many households. Let's start with the spousal IRA because this one surprises a lot of people. Most people think you need to have earned income to put money into an IRA. So if my spouse is not working, that option is off the table. Well, that's not true. The IRS allows what is called a spousal IRA. If you file your taxes jointly, the working spouse's income can cover both of you. That means you can potentially contribute up to $7,000 each in 2025 if you are under 50, or $8,000 each if you are over the age of 50, even if one spouse stays home. Now, keep in mind that these dollar amounts can change. The IRS adjusts contribution limits every few years to keep up with the inflation. So always check with the current year's rules before making that contribution for that year. So for a married couple, that is up to $14,000 to $16,000 per year you can put away instead of just one contribution. Over the time, that really adds up. Now the choice becomes between choosing whether to make the contribution for a traditional IRA or Roth IRA. For traditional IRA contributions, there is a possible tax deduction today depending on your income and whether you are covered by a workplace retirement plan. For Roth IRA contributions, there is no income tax deduction now, but qualified withdrawals in retirement are tax-free. Sounds simple, right? But here is where the IRS puts some restrictions. For married couples considering a Roth IRA in 2025, it is important to understand the income limits that determine your eligibility for a contribution. If your household income is under $236,000, you can make a full contribution to your Roth IRA. When the income is between $236,000 and $246,000, you are eligible for a partial contribution. However, once the income exceeds $246,000, you cannot directly make contribution to a Roth IRA. These limits can make a big difference in your retirement planning. So always check where you stand before making your contribution. Remember, these limits are adjusted frequently by the IRS, so staying informed ensures you make the most of your savings opportunities. It is important to remember that withdrawing earnings or gains from a Roth IRA before the age of 15 and a half and before the account has been open for at least 5 years may result in additional taxes and penalties. One of the biggest advantages of Roth IRA is that you can take out your original contributions at any time without any tax consequences because these contributions are made with your after-tax money. For traditional IRAs, whether you or your spouse can deduct your contributions depends on your status as an active participant in a workplace retirement plan. If neither spouse is an active participant in a workplace retirement plan and your household income is below the IRS limit for the year, both of you are eligible to contribute the maximum to your IRAs and claim the full deduction. If one spouse is an active participant and doesn't qualify for the full deduction, the non-working spouse may still contribute the maximum and potentially get the full deduction depending on your household income. If one spouse is covered by a retirement plan at work, the non-working spouse's IRA deduction begins to phase out once the household income passes $236,000 and it is not available at $246,000 or higher. If both the spouses are not covered by a workplace retirement plan, you can claim your full deduction regardless of your income. Now the question is, are you considered as an active participant? You will be considered as an active participant if the retirement plan box is checked on your W-2, even if you haven't made any contributions yourself. Simply being eligible or having your employer make a contribution to your retirement account qualifies you as an active participant. The bottom line is, using a spousal IRA can really accelerate your retirement savings as a couple, but it all comes down to understanding your income level and whether either of you is considered as an active participant in a workplace retirement plan. If you like what you're hearing from me and find this information helpful to you, please do me a favor. Please scan this QR code on the screen to follow us on Facebook and subscribe to our YouTube so that you will not miss an episode of the Ameriwealth Talk Show. Now let's talk about one of my absolute favorite strategies, the Health Savings Account, or most commonly referred to as HSA. To be eligible for a health savings account, you must be enrolled in a high deductible health plan with a deductible of at least $1,650 for self-only coverage or $3,300 for family coverage in 2025. Most people think that an HSA is just another checking account for doctor's visits. But if you use it right, it is one of the most tax advantage account out there. Here is why. It has triple tax benefits. Number one, contributions are tax deductible. Number two, accumulations or the growth is tax-free. Number three, withdrawals for qualified medical expenses are tax-free. This combination is very rare in tax planning world. Contribution limits in 2025 are $4,300 for individual, $1,550 for families, plus $1,000 catch-up if you are 55 or older. Here's where it gets interesting. Instead of spending your HSA contributions each year, invest them. Treat your HSA like a retirement account you will use later for healthcare. Let me walk you through the magic of compounding with an example. Imagine a family maxes out their HSA contributing $8,550 each year for 10 years. Over those 10 years, they are putting away a total of $85,500 in contributions. They invest that money in a portfolio earning 8% annually. After 10 years, assume that they stop making new contributions, but their investments keep working for them. By year 10, their HSA could have grown to about $124,000. Fast forward to year 15, without adding another dime, that balance could have reached around $182,000. And by year 20, it could be nearly $267,000. Here's the kicker. If those funds are used for medical expenses, every penny is tax-free. That's exactly why I always remind people, don't treat your HSA like it's just for another doctor's visit for this year. Start thinking about it as a secret retirement superpower for your 60s, 70s, and beyond. Here's a fact that you should also remember. HSAs are individual accounts, not joint, even if you are contributing for your whole family. And here's an important heads up. If you take money out of an HSA for non-medical reasons before the age of 65, you will owe regular income taxes plus a 20% penalty. But once you turn the age of 65, if you use HSA dollars for something other than healthcare, it is just taxed as an ordinary income. There's no additional penalty. Let's put everything together and recap. Spousal IRAs let both spouses save even on one income, but please pay attention to income phase-outs and active participant rules. HSAs are triple tax advantage and can become a six-figure account for future health care if invested wisely. And the time value of money sources, steady contributions today can grow into tax-free resources tomorrow. As always, while I am sharing the strategies as a financial planner, please check with your CPAs or tax professional before acting. Everyone's situation is different and taxes are one place. You don't want any surprises. As we come to end of today's show, here are your main takeaways. Spousal IRAs can help you double retirement savings even if one spouse doesn't earn income. HSAs give you triple tax advantages and can turn into a powerful healthcare retirement fund. Here is your action step for the week. Take 15 minutes to review whether your household qualifies for a spousal IRA contribution and check if your health insurance plan is HSA eligible. If you are not sure, ask your HR department or talk with your CPA. A little clarity today can add up to thousands saved tomorrow. Please check the show notes for resources. I have included links to IRS Publication 590A and Publication 969, plus a simple checklist to help you evaluate your option on our website. All right, everybody, that's it for today. I hope you enjoyed the show. Thank you so much for joining me. As I said in the first episode, this show is for you and I want to hear from you. Your questions and ideas will drive the show. Let me know what strategies have worked for you as a W-2 earner. What questions would you like me to cover in future shows? You can send me your questions right from our website, Ameriwealthfinancialgroup.com, or send an email to info@ameriwealthfinancialgroup.com with the subject line, question for the talk show. You can also find me on social media. I hope this episode is helpful to you. Please share it with anyone who may need a little more financial confidence. When we share knowledge, we all grow stronger together. I look forward to continuing this conversation and helping you make smarter financial choices. Until next time, this is the Ameriwealth Talk Show. I am Karan Murugesu and I will see you again soon.